You've bought and sold shares a dozen times. But here's a question that stops most people cold. How many of those trades actually put money into the company itself? The honest answer for almost everyone is once, or maybe never at all. In this episode, we're going to clear up exactly where your money goes every time you trade, because it's almost never where you think. This is one of the most quietly misunderstood ideas in all of investing. Get this distinction clear, and a huge amount of confusing market vocabulary, IPOs, exchanges, listings, suddenly makes complete sense. Let's start with the primary market. This is the one and only moment a company creates brand new shares and sells them directly to investors. Money flows in one direction only, straight from the investor's pocket into the company's bank account. This is the company genuinely raising money for itself. The most famous primary market event is the initial public offering, or IPO, the very first time a private company sells shares to the public. Before the IPO, the company might be owned by its founders and a handful of early investors. The IPO is the moment it opens its ownership up to everyone else, and in exchange, receives real capital it can use to grow. This is the single most important fact in this whole episode. In a primary market transaction, the money you pay genuinely goes to the company. It might use that money to build a new factory, pay down debt, or fund research. This is the one moment where buying a share is directly, literally, funding the business. Now, the secondary market. This is every single trade that happens after that original primary sale. When you buy a share on the stock exchange, you're not buying it from the company. You're buying it from another investor who already owned it and simply wants to sell. This reframes what a stock exchange actually is. The NSE, the BSE, the NYSE, the NASDAQ. On any ordinary trading day, the overwhelming majority of activity happening there is secondary market trading. Millions of shares changing hands, investor to investor, with the original company simply watching from the sidelines like everyone else. So where does your money actually go when you buy a share on the exchange? It goes to whoever sold it to you, another investor, cashing out their position. The company itself doesn't receive a single rupee or dollar from that trade. It already got its money, once, back at the primary sale. Let's put them side by side. In the primary market, the company itself sells the share and receives your money directly, but this happens rarely, mainly at an IPO, FPO, or rights issue. In the secondary market, another investor sells the share and receives your money. And this happens constantly, every single trading day. Only the primary market actually funds the company. Think about a single share's entire life story. It's born exactly once, at an IPO or similar event. That's its one primary market moment. After that, it can be bought and sold thousands, even millions of times, investor to investor, for decades. Every single one of those a secondary market trade, with the company never touching a rupee or dollar of it again. This is one of the most common misunderstandings in all of investing. Buy shares of any well-known company today, on any ordinary trading day, and your money goes to whoever sold you those shares, not to the company. The company only ever received money from that specific share once, at its original primary sale, which may have happened years or even decades ago. An IPO isn't the only way a company taps the primary market. A follow-on public offer, or FPO, lets an already listed company issue and sell more new shares later on. A rights issue offers new shares specifically to existing shareholders, often at a discount. Both are genuine primary market events, new shares created and sold directly by the company for real new capital. Here's why the secondary market genuinely matters, and isn't just some side effect. Without it, Buying a share would trap your money with no way out until the company itself decided to buy it back, which almost never happens. The secondary market is what gives a share liquidity, the ability to turn it back into cash whenever you want, by simply finding another investor willing to buy it from you. As always, let's line up the vocabulary. The first ever public share sale is an IPO in both countries. An additional sale of shares by an already listed company is an FPO in India, generally called a follow-on or secondary offering in the US. New shares offered specifically to existing shareholders are a rights issue in India, a rights offering in the US, and secondary trading itself happens on the NSE and BSE in India, the NYSE, and NASDAQ in the US. Let's bring this together. The primary market is where a company creates and sells brand new shares, directly receiving your money. This happens through an IPO, an FPO, or a rights issue. The secondary market is every trade after that, where investors simply trade existing shares with each other, and the company isn't a party to it at all. The stock exchange itself is overwhelmingly a secondary marketplace, and that secondary market is exactly what gives a share its liquidity, the ability to turn it back into cash whenever you need to. So here's the question this naturally raises. If the company already has its money and isn't even part of most of the trading that happens afterward, why does a share's price keep moving up and down every single day? What's actually driving that? That's exactly where we go next. If this cleared up exactly where your money goes every time you trade, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow and reach more people just starting out. See you there!